Hi, welcome back to Let's Talk Forex. So today we're keeping it really practical. We're going to be talking about a very popular trading indicator that a lot of traders use. And we're going to just be giving you a few tips to be able to hopefully use them a bit better and a bit more efficiently. And today we're going to be talking about Bollinger Bands. So today we are going to be talking about Bollinger Bands, as we mentioned at the top. They basically show you the volatility of a market. They've got three bands. So you've got the middle band, which is a 20 moving average, a 20 simple moving average. Then you've got the outer bands that basically contract and expand with the volatility in the market. And these are basically two deviations away from the simple moving average.
When the bands widen, the market is volatile. And when they pinch, the market is going to be quiet. But this just gives you context, right? This isn't a prediction. So a move to an outer band isn't a buy or a sell signal by itself. It's the market saying that price is stretched given current volatility. And your job is going to be decide whether that stretch is likely to revert or whether it's likely to continue.
And as we always say, context is king. So in order to decide basically how to use the Bollinger Bands or what playbook you're going to use, you need a couple of parameters and you've got to follow a certain set of rules in order to use them correctly. So before you look for entries, you're going to look at your regime. If you've got choppy or sideways conditions, you might consider, well, not in a chop, but if you've got a trading range, you might consider a mean reversion play. And this is where the price stretches towards the outer band and then comes back again towards the 20 period moving average, of course, if you're using the default settings. Then if you have directional trending conditions, you're going to consider a continuation stance. So you might see price hugging the outside band if it's in an uptrend for a long time, even though price is hugging the edge of the band, you don't want to then fade it to the middle band, because in a trending market, it's going to continue hugging that outer band. And then if you have sort of quiet to active shifts where the bands are compressing for a while and you're getting a long period of consolidation, you might then wait for a volatility expansion. That's often what happens once you get that consolidation that happens for a while.
Yeah, exactly. And that choice right there you discussed there, Alison, is really important here. You're thinking about reversion or continuation, and that should be explicit. So most mistakes with Bollinger Bands happen because traders use a reversion mindset in a trending market, or they're using a breakout mindset in a ranging market.
And, you really need to read the bands like a dashboard, I guess. And here's what you got to look for sort of on a practical level. First, you got to look at the bandwidth. Wide bands, as you mentioned, Chris, indicates a fast, volatile market, whereas the narrow bands, when they're close together, indicates a quieter market. And you're obviously going to adjust your expectations for how far and how fast price can reasonably move based on what you're seeing that Bollinger Band indicator show you. Then you're going to look at the slope of the middle band. If you've got a middle band, so that 20 SMA sloping up, you're probably in an uptrend. If you've got it sloping down, you're probably in a downtrend. And if it's sloping sideways, or you sort of getting price moving up and down above and below that band, then you've got obviously a mean reversion play on your hands. Then you get touches and closes of the bands. So a single touch might mean that, the band is slightly stretched, but it doesn't necessarily mean that you're going to have a reversal immediately. So you've really got to read the context.
Yeah, absolutely. And you got to also want to watch how price behaves when after touching an outer band. As we mentioned here at the top, context is really key here. Quick snapbacks imply that there's going to be a mean reverting condition, but grinding along that band also, that's going to apply trend continuation. And that behavior shift is really your tell.
And then you want to turn what you see into decisions. I mean, that's why we're here. That's why we use the bands. So you have three practical decisions to make once you see what the bands are doing. Firstly, you got to decide on your entry. So if you've seen a range, for example, your bias would probably be towards fading stretches back to the middle band. So in other words, once it hits the outer band and you've seen a mean reversion play, say over the last day, then you'll probably fade back towards the middle band. If you're getting a trend or a fresh expansion, then your bias will probably be towards going with the trend. Then in terms of your stop placement, use the bands to avoid stops that are unrealistically tight for the current volatility. So that's a nice thing about the bands, like the ATR, they give you an indication of what's happening in the market. So if you've got high volatility, you don't want to be putting your stop too tight. You want to give your trade some room. If they're narrow, then of course you don't need that wide leash. You can actually put them a little bit closer and that'll protect your position. And then of course you want to look at your position sizing, very, very important, especially if you're starting out and you haven't used them before. If you're on a live account, or even on a demo account, practice with a very small position size in the beginning until you get the hang of how the Bollinger Bands work. So you want to scale your size inversely with the bandwidth. So if you've got a stop at a certain percent, make sure that you're only stopping as much money as you want to risk. And from there, you can determine how big your position size is. Wider bands mean higher than expected noise. So of course, you want to trade smaller. And narrow bands mean lower noise and less of a chance of you being stopped out with a tight stop. So that's how you can sort of gauge how big your position should be.
Yeah, exactly. And that sizing adjustment there is going to save you a lot of grief. As you mentioned, specifically for beginners just starting out, the bands are going to tell you how much, as you say, how much noise there is in the market. And when there's a lot of noise, you want to turn that volume knob down a little bit and you want to change your risk accordingly.
On that point, you also want to look at your risk-reward ratio. On a mean reversion play, of course, your risk-reward ratio is going to be slightly less just because that's the market regime. It's the way that market conditions work. You can't ask too much of the market if you are, going up and down in a range. Whereas if you're in a trending market, of course, you'll engage, you could probably ask for 1 to 2, 1 to 3, 1 to 4 risk-reward ratio. So that's also something to consider when you're trading using the Bollinger Bands. And then the next step is you want to look at your confirmations. And I think this is probably one of the most important aspects in trading, and especially for beginners. Don't try and predict what the market is going to do. Wait for confirmation before you enter. So Bollinger Bands are best used as a framework, and you want to pair them with some non-overlapping signals. And in other words, indicators that aren't the same as the Bollinger Bands or don't do the same thing. So you don't want to pair them with other volatility indicators because you've already got that on your chart. So you may want a trend filter, for example, a higher time frame bias, which is what we always recommend. Look at the higher time frame before you trade anyway. You don't want to be fading when the market is in a longer term uptrend. You don't want to be fading like a mean reversion play. So you've got to be very aware about what the market is doing. You want to look at participation. For instance, whether the momentum or the range expansion is actually building, and you don't want to jump in on the first stretch. You want to wait for that confirmation before you get in.
Yeah, exactly. And it's really important to keep it simple here. I mean, we see a lot of beginners jump in all kinds of indicators and on their charts. Yeah, if every tool is saying slightly the same thing in a slightly different way, you're just adding noise. You're just making your life more complicated, and you're going to make your trading more difficult to pass, and you're going to make more mistakes. So you want independent confirmation, not an echo chamber.
Then you also want to use divergence. So we've actually made a video on Bollinger Bands and the RSI, and it specifically shows you how to trade those divergence signals. It's something that traders love spotting, but it is quite easy to misuse. You want to think of divergence as a context enhancer, not a standalone trigger. And I think that's also important because what I often find is that traders jump in too early with divergence. So you really need to have that confirmation with the divergence before you jump in.
Yeah, exactly. And I think, as you mentioned, they've got a video on it, but just as a quick example, you want to pair bands with that one independent tool. I mean, it doesn't have to be RSI, but RSI is commonly used. If the price is making a fresh high, while your RSI makes a lower high, then you've got divergence. And it's something to be very aware of. And that's what the RSI is quite good at. In ranges, that can support a reversion bias. In strong trends, it's going to be a caution flag that there's a possible reversal coming up rather than a fade signal.
And then, just some tips to avoid divergence becoming a trap. Number one, respect the market conditions first. As we said, in a real trend, divergence can stack up for a very long time. So don't jump in at the first signal of divergence. You might find that it'll go on for a lot longer than you anticipate. Make sure that there is a structure change. So you could treat divergence as an early warning, but wait for price behavior to confirm that. Stop walking the outer band, regain the middle band, or show, a narrowing bandwidth. It could be the 3 conditions that you look at before deciding that it is indeed a divergence at play or a reversal at play. Then keep it minimal. 1 divergence read plus one trend filter is enough. If you put lots of, as you say, Chris, lots and lots of oscillators on it, it really does get very confusing, especially if some lag a little bit longer, will lag in their signals. You're going to get a lot of confusion happening. And then again, risk and sizing. If you do act on divergence in a noisy market, keep the size modest, as we were saying, place stops outside the typical band noise. And divergence is basically about probability. It's definitely not a certainty.
Yeah, of course. I mean, and that's I think everything that we talk about in these strategies, it's always about probability. And that's what we're trying to do, is tilt the probability in your favor. The bottom line here is that divergence tells you about effort in the market versus results. So if the price is working harder for less progress, while the bands are stopping, so they've stopped expanding, then that's really when you want to pay attention. But let the market conditions and the confirmation do the heavy lifting. Don't commit capital into the first signs of any kind of divergence. You want to make sure that there is a confirmation and divergence before you jump in.
And just to wrap up, I just want to talk about 4 common pitfalls. So firstly, in general, trading with Bollinger Bands. So firstly is fading in a real trend. If price keeps riding the outer bands, don't try and fade to the middle band, because generally with a trend, it'll carry on going, whether it's up or down. Next, entering on the first stretch after a very quiet period, what you often find is that volatility clusters. So the first push out of a squeeze can often be the start of several pushes. But you want that character to reveal itself before you commit to a trade. Then parameter fiddling. So constantly changing the back or the deviations to fit what happened today is really not a good idea. You want to keep it very consistent. Pick reasonable settings and focus on market condition identification. Then, of course, ignoring your costs and frequency. Band tactics can trigger often. That's just what markets do. So if you take every micro signal, then you're definitely going to land yourself in quite a tricky situation. Death by 1,000 cuts, or death by 1,000 small stops can still be quite a lot of losses.
And a useful rule of thumb here when you're using Bollinger Bands, if the middle band is your enemy, so if price won't even revisit it, your idea is probably fighting the market conditions. So you want to stop, you want to step back and reassess, and you want to adapt. So don't keep on pushing if it's not working.
I often say, try your trade idea. If it doesn't work, maybe try it again. If you find that maybe your entry wasn't perfect, if you've entered a divergence too early, for example, try it one more time. But if it doesn't work the second time, just stop on that idea, basically.
Yeah, that's a great idea.
Then we've got a simple, repeatable workflow. So here's a checklist that you can run through literally in under 1 minute if you can be trading with Bollinger Bands. So number 1 is your market conditions check. As we said, look at your higher time frame. Try not to trade against the higher time frame. Move down to your lower time frame and ensure that you're trading the appropriate Bollinger Band strategy depending on what the market is doing, whether it's trending or mean reverting. Then choose your playbook. If you've got a reverting condition, you're going to be fading the moves from the outside to the middle band. If you've got a trending market, you want to enter, as price maybe pulls back to the middle band and then shoots up again. Then you want to look at your confirmation. So you want one trend filter and you want an independent clue. You don't want anything redundant. Don't add too many oscillators to your chart. It's going to just become very confusing. Then you'll plan your trade. You'll enter logically with the playbook that you've chosen or that's appropriate for the market condition. You'll stop beyond the typical band noise, and then you'll size your risk or your position depending on the volatility of the market. And then you'll manage your trade. If price respects your theory, great. If it starts doing the opposite of what you think it's going to do, you might want to pull off part of your position or close your position entirely.
Absolutely. There's some very good that's a good checklist you got there. And again, as we always say, you really want to journal this as well. It's going to take some practice to use these correctly and to use them in markets. So it's going to be really helpful to journal it. Because what you're doing is you're training yourself to see the same market the same way tomorrow. So you want repeatability here.
So yeah, Bollinger Bands aren't magic, but they're a good way to keep your analysis grounded in the current market conditions and the market character. And if you use them that way, then, you'll pick the right battles and you'll size them sensibly and manage your risk.
And treat them, they provide context. They're not prophecy here. They're not going to magically solve all your problems. You want to diagnose the market conditions. You want to choose the right playbook, use Divergence as a context check, and then demand independent confirmation somehow as well. Do that consistently, and Bollinger Bands will become less of a line on the chart, more of a disciplined process that's going to really assist you.
Thank you so much for watching. If you enjoyed this episode, please give us a thumbs up, and please remember to subscribe if you're not already subscribed, and we'll see you in the next episode.
Thanks so much, Alice.
Cheers, Chris.